other lesson, I was trying to teach you that in the forex trading we have what we call the currency pair. Okay, and this analogy that I'm about to teach you applies to all the other things. All right. So um, we have what we call the quote price and the base price. Okay. So in terms of forex trading, okay, in terms of forex trading, we have um, the base price being the currency that is inherent, the currency that you have, and the quote price being the currency that you are exchanging it for. So if you have the cities and you want to get the dollar, okay, your city that you have is what we call the base currency. The city that you have, that is the base currency. Okay, the city that you have, that is the base currency. Then you have the dollar being the quote currency. All right. So what you have is the base, and what you are exchanging it for is the quote. All right. So when you look at the GBP, JPY, okay, the GBP is the base currency, then the JPY is the quote currency. So the first one, so when you take the Euro JPY, the Euro, okay, is the base currency, then the JPY is the quote currency. When you take the Australian dollar euro, the AUD, which is the Australian dollar, is the base currency, then the euro is the quote currency. As simple as that. All right. So I want to switch to Google again. Then I want to explain certain things to you. So I want to talk to you about briefly about forest sessions, and this one is covered in another video later that is related to something else. So when you get there, you'll be able to understand it better. But I'm just giving you an overview here. Okay. So we have the forest. Let me check for forest sessions. All right. Let me use this one. So this is the image. Okay, so we have four times that we use to trade. Okay, so it depends on the country that you are in and the currency that you are trading. That will determine the time that you have to trade or the time that is most likely to have good trades. So you cannot just be trading at any time that you want. Sometimes if you trade at times that they are not, it's not liquid enough, you may have bad trades, and the market will frustrate you because you'll be in the trade for a very long time before it will move, and you pay a lot of money to your broker because at that time there's no buying and selling. So your broker has to force a lot to make the trade happen for you. So in compensation to that, you have to pay more. Okay, but when you trade at a time that the market is liquid, okay, or there's a lot of volatility. It's called the spread. The spread is what your broker charges you, all right? And it will be smaller because, as I said, it's your broker that takes you to the forex market or to the exchange. So he needs to take transportation fee, okay? And that transportation fee is in commissions and spread, okay? So if the price of, let's say, dollar is, let's say, $1 is to one ceding, okay, your broker will make it 1 is to 1.05, so that the 1.05, so when you're entering the market at 1 is to 1, it will rather take you at 1 is to 1 is to 1.05, so that 0.05 is the spread that your broker is taking. Okay. Either your broker will give you that or your broker will take you commission. So it means that when you take any trade, okay, it's that your broker will take you maybe 20 cents, 10 cents for that particular trade. Then you have some brokers that are also very wicked, that they take the two. They will take their spread and they will take their commission too. All right. So it depends on what kind of broker that you're using. But what is the nutshell? The nutshell is that, or what you're supposed to take out from this is that don't trade at the time that you'll be paying more. All right. So we that we are in Africa, especially West Africa, like Nigeria, Ghana, we are blessed because the time that we are weak, that is when the market is very volatile. Okay. So we have four sessions. We have the Sydney, we have the Tokyo, we have the London, and we have the New York. Okay. So the Sydney, the market, as I said, trades 24 hours, 5 times in a week. We just some brief pauses. Okay. So except crypto trades 24/7. Okay, 24/7, 7 times in a week. Like every day, crypto market is moved. Bitcoin trades every day. All right. But when they're talking about the forex, the commodity, and the stock market and things, they trade 5 times in a week. That is Monday to Friday when the banks are open. When the bank closes, they close. Okay. So all these are this Sydney time is when the Sydney Bank opens and closes. So the Sydney Bank opens at in GMT time at 9 o'clock and closes at 5 a.m. for us. Okay. The Tokyo banks open at 11 o'clock and they close at 7. The London banks open at 7 and they close at 3. Then the New York banks they open around 12 GMT. 12 p.m. GMT and they close at 8. Okay, so when they close, the seasoning opens and it's like that. Okay, but the London and the New York session are the main trading sessions, right? They are the most volatile, and so our trade it starts from 7 a.m. to like 8 in the evening, 8 p.m. And during those times, the market is considered um, volatile or liquid. But when you want to trade, unless you are trading um, pairs that have AUD and JPY in it, you don't have any business trading from 9 o'clock p.m. to like 5 a.m. or 6 a.m. in the morning. But most of the time you'll be trapped, okay? In the Sydney and the Tokyo session, it's not a major session. The main major sessions are the London and the New York. They control the market. So we are fortunate that it falls in our time. And that means that if you learn this thing well, you can make a lot of money. So that is the overview of the trading session. Okay. So like the way human beings, okay, everything has measurement. So human beings, we measure our movement in steps. So when I move, I've moved 2 steps, to move 3 steps. So okay, as I'm walking in steps. Okay. When we are measuring weight or mass, we say that we are measuring it in kilograms or grams. When we are measuring time, we measure it in minutes, in hours, okay, and in seconds, okay. So the same way, when you want to measure the movement of prices, okay, in the financial market, we measure it in pips. That is, we measure it in pips, okay. Pips are what we call the movement in forex market, okay. So when the price move one point to the other, we will say that it has moved this amount of pips, PIP, pips. Okay. So it's a pip, but if it's more than one, we call it pips. All right. And you have to understand how the pips work so that you can understand the movement. It's just like the way the time works for you. So in the time, we have seconds, we have minutes, we have hours. Okay. So in the same thing, okay. So let's assume that the pipette is your second, the pip is your minute, okay. Then when your pip graduates, okay, then it becomes, I don't know if you have something like mega pips, but it's called, then that's when we make it in 10 pips, 20 pips, 30 pips, okay. But I will explain that shortly. So that's how it is. So 10 pipettes make 1 pip, okay. Then when it's always from 1 to 9, 1 to 9, 1 to 9, then it moves to the other one. Okay, so you see this is 5. If it becomes 6, 7, 8, okay, then 9, instead of it to become 10, it will increase this one to become 2. So instead of 1, 5, it will become 2, 0. Then it will start again, all right, like that. Then if this one also goes from 1, 2, 3, 4, 5, 6, 7, 8, 9, instead of it to become 10 here, it will move and this one will become 3. Then now we say that this one has moved 10 pips. Okay, because here has moved increased by one. So instead of two is three. Okay, then here will become zero. So it will be 10 pips. If here becomes instead of three, here becomes four, that is 20 pips. Okay, if it becomes five, that is it has moved 30 pips. Okay, and the pairs that have their quote price in USD, that have their quote price in USD. Okay, the currency pairs that have their quote price in USD mostly have one, two, three, four, five decimal points. Okay, before they always have five decimal points. Okay, so you can say 1.13215. This is 1, 2, 3, 4, 5. But the pairs that have JPY, okay, they have three, and it's the same thing. So this one, the fifth one, okay, the one with the, let me show you, I'm coming. Let me go to trading view as I explain trading view to you so that you can have an idea of what I'm saying. Okay, let me go to products, super charts. Okay, so this is Apple stock. Okay, this is Apple stock. Okay, and this is an overview of trading view. It's not complicated. Okay, it's very simple. So let me go to GBP USD and okay. All right, so this is the daily time frame. So every this candle that you're seeing, every one of them is 1 day. Okay, you'll get to understand it. Let me make it smaller. No, let me maybe make it 1 minute so that we can understand this. All right. So I just want to give you the particle here. Okay. So this is trading view. So as I'm saying, you see that this is British pound and the US dollar. So the British pound here, this is the um I'm coming. Let me get the pointer. Okay. So you see this is the British pound and the US dollar. Okay, so the British pound, okay, this British pound, this is the base, and this US dollar is the quote. So the quote is what we quote the pricing. So everything that you are seeing here, this is the quote price. Okay, meaning that at the time that I'm making this video, I'm talking right now. Okay, one British pound is how much in dollar? Is 1.34138. Okay, but it keeps on, it's not stagnant, it keeps on moving. All right, it keeps on moving, and this is the time. So it's just like a graph, the graph that you learned in school. Okay, so you have your y-axis and you have your x-axis when you are looking at the financial market. Okay, so your y-axis is the quote price. So in this case, the price is being quoted in a dollar. Okay, then you have the time. So you can see 12 o'clock. So right now, my time is around 2 uh 2 9. Okay, that is why this candle is meeting. So every candle that you are seeing is 1 minute. All right. So this is what I want to talk to you about. You see the you see the markup. Okay. So you see that this is 1.34050. So look at the decimal place. The decimal places are 1, 2, 3, 4, 5. Okay. So when you see now here is 1.34126. Okay. So if it becomes right now is 2, 2. So it has moved how many pips? It has moved 3 pips. You understand? So you see that the pips are not stagnant. So that is the movement. Okay. So you see that it's maybe this is what I'm trying to show you at the other side. Okay. So now you see that it's 50. It comes 138. Then now let's see. It will move 148. 138 to 148. Okay. 138 to 148. That is how many pip? That's 1 pip. Okay. And that's 1 pip. It's now 158. This is 2 pips. So assuming that I entered the market here, okay, I've gotten about 2 to 3 pips right now. All right. Okay. And I bought. This is buying. If you see the green means that it's buying. And if you see the red, it means that it's selling. Okay. So all this thing, the market is selling. People are selling the British pound. Here, people are buying it. If you see green, green, they are buying it. As simple as that. All right, so let's go back to this one. Okay, so that's what we are seeing here. This is the same thing that is here. That is how we measure it so that you don't see it as abstract as I'm teaching you. So that's it. So this is the Euro USD. Let me even open Euro USD so that it will be more simpler. Okay, so that you can relate. So Euro USD. Let me choose Rwanda. All right, so this is Euro USD. So you see the same thing. So it's the same thing. One, two, three, four, five. So any of the currencies that is quoted in the US dollar, okay, has 5 decimal points. So right now, $1 is 1.16718. Sorry, 1 euro is 1.16712. So when it moves, it keeps on counting. So now it has a 711. So let's see how it will move. 711. Okay, now it's 719. So how many pippets? Okay, it has moved, it has moved about 6 pippets. So it's not just one, it's not even 1 pip. Okay. They said I didn't sign into this. So they are telling me to join for free. I've exhausted my and I don't want to sign in. Okay, so yeah, you get what I'm showing you. All right. I just wanted to explain this one to you. So that's how it moves. So the price is not stagnant. The price is moving up and down, up and down, up and down, up and down. That's why you need a strategy to be able to enter at the time that you're supposed to enter. Because if you just enter based on it's the things moving up and down, okay, you will be caught off guard, okay, and you will lose a lot of money. That's why you need a structured approach to this. All right. So when you have let's say I'll show you about the movement, okay, then let me take you to lot size and relate it to something that I showed you in the other video. So we have lot size. So remember I told you that your broker, okay, your broker helps you to trade, it gives you 99% of the money that you're supposed to trade with, okay, and they give you leverage. So assuming that you're supposed to enter a trade for Euro USD, okay, you need about 100,000 units, and 100,000 units is $100,000, which you don't have, okay. So if you want to enter that trade, your broker has to help you because when you enter 100, when you have, let's say, assuming that you are not using a broker and you have $100,000 and you enter a volume of one, that is one lot size, okay. Every pip movement, like what I showed you, that I moved 3 pips when you're checking the GBP USD. Okay, it moved how many pips? It moved 3 pips. So now, if I had this deposited in my account without a broker, like on top of this, I would have just earned $30 because you multiply the pip by the amount that you are making on. So that's why you see $10 per pip. Okay. So when you go one lot size, you are trying to say that you want 100,000 units. And the 100,000 units, every one movement in price in your favor is $10. When it goes against your favor too, you lose $10. Do you understand? The mini lot size is buying 10,000 units, and that is you enter the trade 0 0.1. So when they ask for the lot size, you enter 0 0.1, meaning that every movement, every pip movement, you want to earn $1 on it. And when you lose to, you should lose $1. So I don't expect you to have $100 and you go one lot size because just a short movement, just a short movement, okay, your $100 will finish because when it moves we are just there and within a short time it has moved 3 pips. So if you have $100 and you went standard lot size of one, just know that $30 of that money is gone. Okay, multiply it by the Ghana cedi and you understand what I'm saying. All right. But if it went in your favor, if you bought, you would have gained $30. So high risk is equal to high reward. Okay. And low risk is equal to low reward. That's how it is. So if you go 0.1, that means that you are saying that every pay movement, you are getting $1 on it. You are getting $1 on it. And if you go 0.01, you know every pay movement, you are getting 10 cents on it. You are getting 10 cents or 100 cents. Okay. Yeah, so you are getting what is 0.1? That's 10 cents. Yeah, you are getting 10 cents on it. All right. And as for they don't use the nano because the nano is too small, so they don't use the nano. So the minimum that the brokers have standardized it to is the micro. Okay, the 0.01. So you can go 0.02. That means that you'll be earning 20 cents. If you go 0.20 here, every pip movement you'll be earning $2. Okay, you'll be earning $2. Let me see if I can reload the way they're telling me to sign in. I wanted to show you how, okay, it has come back. All right, so as you can see, so the price movement, okay, so you see that every pip movement, so now it has moved 1 pip. So if I went with one standard lot size, okay, I would have made $10 right now and I would have lost $10 again. So that's how it is. So it has become one again. I've made $10 if I went to 1.0 lot size. Okay, then you'll be waiting. So right now I've made $20 because it has become 20. So I've made $20. I've lost $10 again, or something like 70 cents. Okay, that's how it is. So I've made that back again because it's now 20. Okay, so that's how it is. So your money is not stagnant. That's why you have to have a plan because your money will it will be just be moving up and down and it will be increasing as it's going. And it will be reducing, it will increase, reduce, increase like that. Okay, so either you gain or you lose your money. All right, so that's how it is. So every pip movement and the lot size that you choose determines how much you're going to make or you're going to lose in the market. So I'm repeating again, standard lot size is 1.0. So if you enter 2.0, they are trying to say that every pip movement you should make $20 on it and or lose $20. Okay. People talk about only the win, they don't talk about the lose. Or when you're losing, you can also lose $20. Okay. So if you have $50 and you have deposited in your account and you are and you are going 1.0, you should know that the price will not move anywhere and you'll be stopped out. Okay, your money will finish. And you come and say Forex is a scam or trading is a scam. Meanwhile, it's your own greediness. Okay, you should have just used 0.01 or 0.02 because of your little money. All right. Yeah, so as simple as that. So that is the lot size. And I've explained the leverage to you. Okay. So it's the leverage that determines how much of your money that the broker should multiply your account with so that you can have the power to be able to open any of this. All right. So if you have $50, okay, and you choose a leverage of 1:2,000, sorry, you choose a leverage, you choose a leverage of, let's say, 1:2,000, okay. What are you trying to say? You are trying to say that you choose a leverage of 1 is to, let's say, 2,000, okay. You choose 1:2,000. You are trying to say that your $50 should be multiplied by what? 2,000. So when you do something like that, okay, so this one you are going to get, let's say, uh, 10, okay, plus another zero. So let's say 10 plus another zero, let's say 100,000. You're going to have 100,000, okay? You're going to have 100,000 positions. So with the 100,000, you can buy one lot size, okay? Because you have increased your leverage. So you can have the ability to open a position of 1.0 and earn $10 per pip. But just know that when the market goes against you, when the market goes against you, within 5 pips, your $50 is gone. But assuming you enter the market and boom, the market shoots up by, let's say, 20 pips, okay, they'll multiply 20 by $10 and you have instantly made $200, okay. But if you had $200 in your account and you opened one lot size, okay, and the movement went against you immediately 10 pips, okay, you have lost all your $200 in your account. That's how it is. All right, that's how it is. You have lost all the $200 in your account. Okay, you have lost it in a space of, sometimes it can even happen in a space of just 2 minutes. You have lost all the $200 or all the $500 in your account, depending on the lot size that you open. All right, so that's a little bit of that. Then I want to end, but I want to show some things, one or two things, and um, we will continue. Let me come here. Okay, so we have types of analysis. Okay, we have types of analysis that you can use to analyze the financial markets. We have types of market analysis. Okay, so we have the most common one that I want to introduce you to. We have the fundamental analysis. Then we have the technical analysis. There are more, but this is what I want to introduce you to. The other ones, I don't think I'll have to go there. So we have the technical analysis. Some people can also add sentimental analysis, psychological analysis, but basically these are what we have. Okay. All right. So the fundamental analysis is when you try to use macroeconomic factors to um, forecast the market, whether the market is going to go up or down, or whether the market is going to buy or sell. Okay. So um, you can use the news, okay, then you can use the macroeconomic factors, okay. So here, if you're an economist, maybe it can help you here, okay, but me, I don't use this much. Okay, so so if you want to study the fundamentals, sometimes it's important because if you don't know, you're trading and you don't know what is happening in the market, okay, you will just enter a price and you just enter and something will come and sweep you and you will not know what came to sweep you, but you are just not abreast with what is happening in the market, okay. So for you to know the important news that are happening in the market, okay, for you to know those things, you have to um there's a site that you go to that is we call the Forex factory. That is the reliable one. That there are a lot, but this is what we use. Okay, the Forex factory. So when you go to the Forex factory, if you come to your Google and go to Forex factory, you will see it will bring you to this page. Okay, then when you go down here, you see the current news. So today is Tuesday. Okay, so when you see the news, okay, we have the folders. We have the yellow folder, we have the orange folder, and we have the red folder. Okay, the orange folder means that it's medium impact. Okay, it's not really shake the market, but medium. The yellow folder means like it's minimal, like the impact is low. But when you see red folder, it means that it's high, but it can affect the market. So you look at the time, 2 p.m. So when it's 2 p.m. and you have a lot of about three red folders, let me see if I can see some of them. Like this. You come here, you see this side, okay, on the US dollar. So you see the currencies and they are red folders, okay. So Friday, 5th September, if you are trading around 12:30, you have to be careful because the price can shoot at any time, okay. Price can shoot at any time and it can go even 100 pips in one direction. And if you are trading your small account, it will wipe you because you didn't know this. Okay. So we have the average hourly earnings, we have the non-farm payroll, this is the NFP. Okay. you have the NFP, you have the unemployment rate all happening at the same time at 12:30. And this is a very major event. So you don't trade around 12:30 when this is happening. And if you don't know these fundamental things, you'll be in the market and price will go against you. Or sometimes if it's in your direction, you feel all of a sudden, boom, you have a lot of money, you don't understand. But sometimes some of these things, so you need to understand. So this is when I'm looking at this, okay, then I come and open the folder and see, okay, non-farm payroll, what has it been doing? Okay, the actual, the forecasted, and the previous. Okay, then I'll use it to forecast. Okay, read this change in the number of employment people, like that, like that. So if um August 1st, it was 73. The actual was 73, but the forecasted 106. That means that it went down. Okay. Is it strong? If you see red, it means that it weakened the dollar. If you see green, it means that it strengthened the dollar. So this time around, what is going to happen? Then you can use it to make your decision. But I don't think that is a very good way to analyze the market. Myself, I don't trade news because